sorry for the slight delay, but there was a bit of a problem with the streaming key. Also, you may notice that I've got a bandage on my finger because it was an incident that involved Teddy. He saw a cat, he was on the lead, and then I trapped my hand on the door, and now I've got a bit of a skin flap and some blood. So if I bleed, please forgive me. But anyway, so it was an eventful evening. So tonight, I'd like to just go through some of the stuff that we're planning for the competition. So we've got a competition where we're trying to create a fantasy portfolio. So I'll talk about that. And let me just start off by welcoming everyone. So hi, Siramis, nice to see you. Lovely to see you, Alain. And he's one of the moderators along with Laura. Randy, hi, how are you doing? Joey, George, hi. And so you do hold off on your questions until I run through what we're planning with the competition. Because I think, let me just explain why we're doing the competition in the first place, the fantasy portfolio, because I think it's really important. What really discriminates between professional investors and people who are new to investing is their attitude to risk. And the attitude to risk amongst professional investors is that you should have a really good handle on your risk. And you can't really create a portfolio without that understanding. And you'll see if you look at the videos on my own portfolio that that's how I start. I start with risk and then I work back to the assets which I like. And I'll very briefly go through that now with you. I'll also talk about the assets which are available as part of the competition, because I think that's kind of interesting as well. And it was a bit of a tweaking process, so I came up with a list. People told me what I'd missed out, and so it's pretty much a kind of agreement with the community about what goes in. So let's start off with why I did it. I think it's fun for starters. That's the main goal. It's going to be fun. There's also a prize, which is a year's worth of membership for PensionCraft, which is going to be in cash. And you can spend that on another year with PensionCraft, or you could spend it on anything you like, obviously. And it's going to be over a 3-month period. So the closing date for the competition will be the end of November. And then by March, the beginning of March, we're going to announce the winner. And the winner is going to be based on the risk-adjusted return. In other words, we'll take the return of your portfolio. Once you've decided your weights on November the 31st, it'll be frozen. Your weights will be frozen for your portfolio. Then on March the 1st, whichever portfolio has the best risk-adjusted return, that's a return on your portfolio divided by the volatility of your portfolio. So notice that risk matters. Whoever has the highest risk-adjusted return wins the prize. And we're hoping there aren't going to be any draws, so there won't be two portfolios which are the same. So that's the plan. I think it will be fun. I think what's always surprising is that you never know which asset is going to be the best performer over that time period. So let's just quickly go through the assets which we've got. And I'll share my screen with you so you can see the portfolio. And if you enter the competition, then you'll find a link to how to join the competition beneath this video in the description.
Just posted.
And Laura's just posted it if you're watching live. Let me just do the camera and picture. Here we go. And I'll make this full screen. So here on the left, you can see the assets which are available. And I've broken it up into asset groups. So global equity, either including the US or not. Country equity, so I've tried to get as many single country funds as possible. So if you think the Philippines is going to be the winner, or Norway or Korea, you can choose those countries. And then we've got regions, so you can do emerging markets, or you can do EM Asia or Latin America. You can go for individual sectors, and unfortunately here I couldn't use UK sectors or European sectors because there aren't really good funds for those, but you can go for US, any of these US sectors, the standard 10 sectors. And then thematic equity. So let's say you think that electric vehicles are going to be the thing, then you can go for that, or timber, or global water, or maybe aging population. And then factor equity, so you can go for small caps, or you can go for growth or value. And again, because the US is so well served with these factor funds, I could only use small cap value and small cap growth by using American funds. So we have to pretend that we have decent funds in the UK. Tricky, I know, but we just borrow the American ones. Real estate investment trusts, I've got one UK one, two others, one which is global and one which is global ex US. And then government bonds, a whole bunch of these government bonds. Remember, these are the ones which dampen the volatility and provide diversification. And then a couple of inflation-linked government bonds, because a lot of people think we're going to get hyperinflation. So if that's what you think, put your money where your mouth is. High-yield corporate bonds, so junk bonds, which have seen their credit spreads tighten a lot. So the Fed's buying those, which has been great for high yield. Some commodities, gold, silver, and natural gas. These were things that people asked me to add, in fact. A couple of leveraged funds, which I know I wouldn't have included because they have very high volatility. But who knows? Maybe the leverage will win over the volatility it introduces. And cryptocurrency, a couple of people said, could we have a couple of crypto funds? In the end, I just went for Bitcoin. Perhaps I should have added a couple of others. And then volatility, so you can go short VIX volatility, or you can go long midterm VIX futures as well. And then finally, a dollar bullish fund. So then you can kind of play around with what your views are about the dollar. So those are the things which are like your paints in your artist palette. But the difficulty with portfolio construction is how you combine those assets into a kind of coherent whole. So let me just show you another thing, which is the correlation of those assets. Hopefully you can see that. Yeah. So this is what the cluster analysis of the correlations for those funds looks like. And the reason why this is useful is because if you want to build a portfolio and you want to see which two assets are very correlated, you wouldn't choose both iShares Core European Government Bonds and iShares European Government Bond 5 to 7 year, because those are highly correlated because they're close together in the tree, which you can see here. Whereas if you choose something from up here in the tree and something down here in the tree, by definition, those won't be highly correlated. So that you'll get much better diversification by choosing different bits of the tree. That's the goal. And that's why this tree is useful, because it tells you what the correlations are. So don't choose things which are close together. Use things which are far apart in the tree, because that way you'll have lower volatility. And then you can say, well, I think this fund within this cluster will be the one which performs best. And I think the fund which is in this cluster, which is not correlated with that, will perform best. And you combine those two assets. So that's why I think these correlation trees are quite useful. They tell you how closely related in terms of price behavior two assets are, according to how close together they are on the branches of the tree. So I can make that tree available to people once they enter the competition, and I think it'll be useful when you're deciding on your own fund. So that's the rules. That's what you get. That's the prize. It's going to run for 3 months, and I'll kind of discuss it on these calls, but also within the community, and we'll have a kind of league table of who's performing best. But remember, it is just a bit of fun. Don't get too competitive. Don't sabotage each other's weights. I've already had one person complain that the portfolio they'd entered was wiped over, which is slightly suspicious. This is what that, if you do want to enter your weights, you just enter in the column. So this is Teddy's entry. He's got 20% UK equity, because he likes UK equity because it's familiar, 40% US equity, and 40% long-dated US treasuries, because he wants a bit of diversification. And if you enter the right level of weight, it'll go to 100% here, it'll go green. And you can also choose your currency. So as long as you choose a fairly standard currency, I'll score your portfolio in terms of that currency by converting the daily prices of the funds to that currency. So that's the way it's going to work, and it should be a lot of fun, I hope. So let me just switch now to YouTube, back to YouTube, and I'll start answering some of your questions. Okay. Right. Bad Teddy, somebody's saying. Oh, he was just excited because he saw the cat, so I couldn't blame him. He was very upset because he saw the finger and he heard me shouting and crying. So actually I didn't cry. I was very brave. Very brave. Right. So let's start answering some of your questions now. Okay, so Kenneth, start with Bitcoin. Good evening, Ramin. I know you're not a huge fan of Bitcoin, but given the recent performance of it, would you consider it a more realistic option? Thank you. Well, look, I mean, I know pension crafters, members of the community have Bitcoin, and I have no issue with that at all, because I think, you know, as long as you realize it is risky and has no way of pricing it in terms of working out whether it's expensive or cheap, the same is true of gold. You know, gold has the same problem. Any asset which doesn't have a set of cash flows which it generates mean that you can't work out its present value based on discounted rates, based on discounted cash flows using a risk-free rate. So, you know, I think that's the problem with Bitcoin. You never know when it's expensive or cheap. It's only worth what people are willing to pay for it. But it's interesting that many people, the narrative around Bitcoin changes all the time. And as each thing is kind of discredited in terms of its applications, you know, is it a currency? You can't really pay for it very easily. You can't use it to pay for things very easily. And I've also already got a very convenient way of paying for things using my phone anyway. So I don't think it's believable or credible as a payment system. It's not really a very useful hedge. Oh dear. My phone doesn't like it either. And if you look at something like, let me just turn that off. If you look at things like the risk of the volatility of cryptocurrency, it's very high. So if you do introduce it into your portfolio, it hasn't diversified. It's just increased the volatility of your portfolio if you have a lot of equity. A lot of people saying before the March sell-off that it was a risk-off asset, that it was a diversifier, but it didn't. It sold off with equity. So I think the kind of list of things which it kind of satisfies, other than a speculative asset, are growing shorter. Not a currency because it's not tied with any central bank. It's not a diversifier in terms of asset allocation, so I think you know, in terms of what it is, well, it is just a speculative asset, and all you can really say is the price has gone up a lot compared to when it was first launched. It's actually down a bit compared to the peak that we had. I think it was a couple of years ago, but you know, it is what it is. And I think for some people it's like a religion, which I think is always a bad thing because it stops you thinking. The minute something becomes a matter of faith that it's going to go up is when you stop thinking, and that's dangerous. But if you go into it with your eyes open, why not? You know, it's fun, and as long as it's not too much of your portfolio, then, and you know, understand the risk of that it is a speculative asset, then yeah, fine.
Jim O'Shaughnessy.
Yes, indeed. So in fact, Jim O'Shaughnessy was kind enough to do an interview with me, which will be going to the current members, PensionCraft members, and that is going to be available to them, the full interview, and then I'm going to release some of the interview as long as Jim's okay with it. He's actually looking at it right now just to make sure he didn't say anything embarrassing and I didn't say anything embarrassing, and then once he's happy with it, we're going to put parts of it onto YouTube in the next couple of weeks. It's quite a long interview, so we'll probably chop it up into little chunks, and part of the discussion is about Bitcoin. really interesting points that Jim makes. As you know, Jim O'Shaughnessy, incredibly open-minded, and he did a wonderful interview with Adam Pompliano where he said he started the thing by saying, I don't know. I don't know. And that's one thing you're told in investment banking. You never say, I don't know. So that's wonderful that he says that, because that is the first step to having an open mind and learning. That's really why he's such a great investor, because he's always learning, and he always will, because he has that mindset. The thing which stops you learning is when you start thinking, I know everything, right? Or I know what I need to know. That's never true. And part of the fun of pension craft actually has been learning from the pension crafters. I carry on learning all the time. They come up with articles which are interesting, they ask a question, and you suddenly think, I've got no idea. I better look into that. So yeah, Bitcoin, I wouldn't say I dislike it. I just think, for me, it's not something I'd consider at the moment, put it that way. Right. Alan says, hope finger gets better soon, Ramin. Thank you. Any thoughts on emerging market index funds versus the S&P 500? This is from Chuck Diesel. Well, again, there was a really interesting article from Bridgewater, which I actually did a video on. I've just shot it and I'm going to release it to the members later tomorrow. But what they make a really interesting point about diversifying your risk premium. And they say that there are 3 poles in the world. And this is kind of what I've been talking to clients about anyway, but it kind of crystallizes it nicely. You've got the US, you've got Europe, and you've got China primarily, which is the largest EM country. So if you buy an EM index, you'll probably have 50% China in there if it's an equity fund. And also Chinese bonds, because yields are zero almost everywhere, but not in China. They're above 3% for government bond yields there. So there are certain things which you can do in order to diversify by moving your money where the risk premium is kind of driven by different factors. And that would be China. China's a really nice diversifier, and it's also quite a deep market now as the size of their capital market gets bigger. So obviously there are governance issues which are a concern. There's also political issues for some people. So Perth Tolley, I believe that's how you pronounce her name, she's created a freedom index which excludes companies which don't satisfy certain ethical criteria about, I guess, issues around freedom and political repression perhaps. But, for some people that's not an issue. But it would be great to interview her, actually, if she was willing to do that, because, yeah. But anyway, so yeah, I think emerging markets are a great way to diversify your equity component. They do have different monetary policy, a different political system, and they're not bound by the same highly correlated economic situation that we have in developed markets. If rates go down in the US, you'll see them go down in the UK and in Europe. The ECB usually follows what happens in the US because our systems are highly correlated, highly interlinked. Whereas China and its trading bloc, which it's establishing in Asia, is quite separate. And generally, that's where you'd expect to see greater growth over the long term. Maybe not by huge amount, but maybe 0.5%, 1% extra risk premium for allocating your capital in emerging markets. So, yeah, I think it's interesting that the S&P outperformed over the previous decade, but if you look decade to decade, there's one country that does well, and it's certainly not the case that the US always does well. There are many decades in which it's underperformed. So diversify, yes. Emerging markets is a good place to diversify, but there are others. Asia Pacific, outside China, but also Europe. And eventually, I guess, Africa as it develops too. So really, you should try and avoid that domestic bias if you can in your portfolio, because we never know which region is going to outperform. And that's why we diversify it. It's a way of admitting you're humble, because you don't know where the outperformance is going to come. So hi Zishan, you're from Watford. Oh, very good. Very close by to Amersham. Good to be live. Point of Living UK, yes. Okay. Yeah, okay. Why is the market at an all-time high, Ivan says. Good question. And there was a really interesting tweet that came out this week from Yahoo Finance. And what it did was list all of the forecasts by equity brokers about what's going to happen to the S&P 500 in 2020. And there was only one broker who had a forecast that was above where we are now. And this was a pre-pandemic forecast. So 96% of the forecasts were actually below where we are today, assuming we weren't going to have a huge earnings recession, which is exactly what we've seen. In other words, the pandemic has actually pushed the S&P 500 way up above these bullish estimates. And you could say that it's because of monetary policy and fiscal policy. You know, the Fed's been printing, and it's also been buying assets. Also, we've seen the governments increasing their, loosening their purses and having lots of fiscal policy, which has been very effective so far. It's about to run out in December. So a lot of these unemployment schemes in the US are going to run out at the end of December. That's a worry because, obviously markets will not like it if millions of people are no longer able to pay their rent or to feed their children. At a certain point, poverty will affect markets. And I think if we don't see some kind of fiscal stimulus in the US before maybe, once those stimulus measures end, I think it'll be a problem for markets to head higher. But those are the combination of factors which have driven markets higher. And when we have so much stimulus, then, it's pushed valuations to crazy levels. But ultimately, valuation always matters. So unless earnings rise to meet the rise of the equity market prices, then we're going to be left exposed. Kind of like an aircraft which is flying upwards, but then runs out of kerosene fuel. So I think as long as equities manage to generate earnings fairly well by Q3 of next year, which is when markets are expected to get back to where they were in terms of earnings, then we'll be okay. If there's a delay for earnings to recover, that's going to be a big problem for US equity. Other markets, not expensive. So the UK, for example, after such a big sell-off, didn't recover. We saw a fairly brisk recovery over the last, after the announcement of the vaccine. So the UK is certainly not as cheap as it was, but it is relatively cheap compared to the US. And there are many other regions which are also cheap, and not as expensive as the US, certainly. But so the market's not terribly expensive everywhere. There are pockets of value always. And value itself is currently very cheap, even after the rotation that we saw after the vaccine. So in fact, 2 weeks ago, I think I said, value's very cheap at the moment. If you're a very contrarian investor, now would be the time to buy it when it's at a 2-century sell-off, 2-century drawdown, 2-century long drawdown. And somebody actually, I spoke to them and they did that. And sure enough, after the vaccine announcement, their portfolio went vertical. So there's an example of someone who was contrarian and had the balls to go out and buy value when nobody loved it. So yeah, those are the reasons why the market's high. But it's not expensive everywhere. Yes, please like this video, and because that helps us a lot. And also consider joining our competition. And you can do that by joining our community, and you can join our fantasy portfolio competition if you're a member. And that ends, the entries for that end at the end of November. So you haven't got long to join us and then enter the competition. But if you do join us, then anyone can enter and you win a year's subscription in terms of cash. So please do join us. Plus, it means that we can carry on producing these videos. Because remember, we don't take any kind of money from platforms or fund managers so that we can stay independent. We depend completely on people such as yourself to keep us on the road. So please do consider supporting us. It helps us a lot, and you may learn something. Who knows? Okay, next question. By the way, if you do want to kind of jump a queue on the questions, just do a super chat. You have to pay a bit for it, not much, a bit, and then you'll jump to the top and I can answer your questions straight away. Right. Zishan says, Zishan from Watford says, fantasy portfolio. Is there only one prize? How about some exciting courses on PensionCraft for the winners as a second or third place? Well, you can always spend the money on a course, so that is an option. We didn't have a second or third place, did we? No.
Offer a course, not the end of the world.
Yes, we could do that. We could do that. Maybe we could change the rules. Should we do that?
Yeah, why not?
Yep, okay. So let's say anything except the asset allocation course, which is very expensive, relatively. So let's say if you get a second prize, then you get one of our courses for free. Good. Don't forget it's not returns that's important. Alan says it's risk-adjusted returns. So you need to calculate the volatility. Good point. So it may be that Bitcoin actually continues storming upwards, in which case, risk-adjusted, maybe that'll be okay if you mix it with something which is uncorrelated, like government bonds. Or it could be that, Bitcoin crashes like it did last time it rallied. So you have to be careful with the risk. Okay. David Garth. Okay, so PJ says earnings recession, as you mentioned earlier, demonstrates that the earnings are a secondary driver for markets. Yeah, I guess that's true. Certainly the policy is dominating at the moment. I'd say politics and fiscal policy, monetary policy are what's driving markets much more strongly at the moment than something like just earnings. But remember that ultimately with equity, it always comes back into line with earnings. It has to. You can't get valuations increasing upwards forever. That is mean reverting. It always is mean reverting. And the time when it's most likely to happen is when people say valuation doesn't matter. That's the kind of catchphrase for me that tells me valuation matters a lot. And at the moment, that's what people are saying. So I think it's true that you can ignore valuations for a bit, but why would you carry on paying more and more for assets that are generating less income and less profit? Well, you wouldn't, right? So yeah, I think it's important that people do look at valuations. And yes, markets are forward looking, but the point is that valuations before this crisis and the forecasts for the S&P 500 weren't as high as we are now, assuming there wasn't going to be a pandemic. So why would the pandemic suddenly make earnings go up more? Why would you pay more now for equity than you would before a pandemic that's completely smashed earnings for a huge proportion of equities? That doesn't make sense, right? So markets are forward looking, and I have looked at earnings reports, but not for single stocks. I don't do single stocks. Right. Oh, I seem to have scooted down a bit. Right, so. Oh, Robert Amphlett says, hi Ramin, off topic. Your website says you attended King's School in Worcester. My dad attended the same school around 1968. I'm assuming you're quite a bit younger. Yes, but could there have been any crossover? I wonder if you have a sister called Kate Amphlett, in which case, yes, Kate was in the sixth form at the same time as me. But there is an Amphlett family I know, certainly. From Worcester, how very odd. Okay. Tom Peachy No, there's a question there for Tom Peachy. Yes. So somebody says, I can't pronounce your username, I'm afraid. It's RGRTNYJJC. I asked about an interview with Lars Kroyer some time back. Any chance this could happen? Yeah, I'd like to meet Lars Kroyer. That would be great. I did ask him for an interview and he was busy at the time, but maybe now I have more subscribers. He'd be more interested. But I can certainly ask him again. It would be great to speak with him. A lot of people have talked to me about his book and I've looked at it. It's very good. And he kind of shares a lot of our investment philosophy. So I think it would be great to speak with him. Yeah, I'll have to add him to the list of people I'd like to speak to. And incidentally, I'd also like to interview someone to talk about Bitcoin, because I always like to hear the other side of the argument. It would be great if somebody would be willing to do that. I would like to do that. Ramin. So Chris Fahy says, Ramin, for your own investments, do you hold any real estate? What are the percentages of your investments in cash, stocks and shares, property, bonds, etc.? Right. So in terms of property, I've sold my house. So I'm living in rented accommodation right now. So I don't have any property at all at the moment. We made fairly big profit on the sale of the house, which is good because obviously in Buckinghamshire, prices have gone up quite a bit since I bought the house many years ago. But now I currently hold, my portfolio is kind of public information. You know, you can watch videos how I invested my own money. There's a playlist on my channel which describes what I do and exactly why I bought what I bought. But currently I have 20% equity, so very cautious. 80% bonds split into UK long duration bonds, which is 40% of it, and 40% in US treasuries, but sterling hedged, because I thought that sterling might appreciate if we get some kind of deal on Brexit, which is now looking rather unlikely, but still. That's why I bought it, because I didn't have a view on currency and I didn't want to have too much volatility in the bond component. So that's my portfolio. That's what I own. And the reasons why I own it, you'll find in my videos. Because a lot of people seem to ask about how I invest, because I think that shows what I truly believe. But I always say, don't do what I do, because for most people, you know, the kind of holding back because valuations are high is a mistake, because most of the time you'll be better off just buying equity bonds in whatever split you're happy with. Some people 100% equity, some people less, usually much less, and sticking with it. And then maybe just tweaking at the margins. You know, if equity markets fall a lot, you rebalance from bonds to equity and buy equity when it's cheap, and vice versa. So for most people, playing around timing market is a waste of time. So yeah, that's how I publish my own portfolio. So please do like this stream if you're enjoying it. It would be great if you did. It would help us a lot if you do. And remember, if you join our community, you can join our competition to work out the best portfolio in the next 3 months. So our fantasy portfolio competition, which should be lots of fun if you're a member. Okay. What do you think of the golden butterfly portfolio, and is there something superior? This is from Ray. So I've done a video about golden butterfly where I use portfoliocharts.com, which is a great website. If you haven't played with it, it's really good, and talked about its attributes. Now, a big chunk of it is gold, actually, in the golden butterfly. And so I think some of the bits of the portfolio depend on the back testing time period. So when you do back test one of these strategies, all you can ever say is that this is what worked historically. And if you get too fiddly with the weights or put too much faith in an exact allocation, you will be disappointed, because the past only ever resembles the future. And for example, if you go back in time, small cap value is by far the best performing equity strategy. But of course, over the last 10 years, it's been a huge underperformer. So I think it's important to understand the limitations of backtesting, but the golden butterfly does very well on the backtests. And so, it's really a very good portfolio in terms of not having drawdowns. When the equity market falls, it doesn't fall too much. And furthermore, when it does fall, it doesn't stay at a low level for too long. It recovers quite quickly. In other words, the ULSA index, which is one of the things that they give you on that site, is fairly limited. So it has lots of good properties. But is it the perfect portfolio? No, of course not. Just in the same sense that any active manager which has performed well over the last decade could be an absolute basket case over the following decade, because their attitude, their approach will just be unsuited to what lies in the future. So yeah, it's a good portfolio, and but there are many alternatives you could think of, and that site has many of them. So as long as you are globally diversified, you should really have a look at Meb Faber's book, Global Asset Allocation by Meb Faber. It's free, but it's very good. He compares many different portfolios, and the upshot is that there's not a huge difference as long as it's not really an awful portfolio, as long as you have a fair chunk of equity in it and it's globally diversified. They all come out doing fairly well. And because we don't know the future, all you can really do is diversify and hope for the best. You can do stock picking, but almost certainly it won't help you, because we just don't know which are going to be the stocks which outperform. Okay. Do you follow Indian markets too? This is Frank Underwood. No, I don't. Not at all. So I couldn't really comment on that at all. And although I did work with a colleague who was based in India, who used to discuss the Indian market with me, but only kind of casually. I certainly wouldn't be an expert in Indian markets. No. Okay, so there's a question from XCH97 who says, I'd be interested in your thoughts on a small allocation, say 5 to 10% of a portfolio to VC, venture capital, private equity, PE, for a longer term investor, and how to get exposure as a UK investor. Okay, venture capital offers certain tax breaks. So if you go for high dividend equity, you'll never get returns, you'll never get dividend yields as high as you would for venture capital. And certainly you wouldn't get to keep as much of the dividend because it's so tax efficient. So that's one of the benefits of VC. The drawback is that venture capital is by definition very risky. You have to be willing to invest in companies where you could easily make 100% loss. So money that you have in your core savings, you certainly wouldn't put too much of it into venture capital, because if you were unlucky and the companies start to fold in a recession, as we're seeing now, then that could be a huge issue for you. Private equity tends to be less risky in some ways because it really depends on the sector in which they invest. But the difficulty for some people is that you have to be a professional investor to become a true investor in private equity. What we can do is buy private equity ETFs, which track lots of private equity companies, but the fees tend to be very high on those. Also, one problem with private equity is that people tend to overpay for private equity, and because it's so illiquid, valuations are quite tricky to know and understand. So certainly some people have done very well with VC and private equity, but probably not for most people, I'd say. But if you do want to get exposure, there are funds which give it to you. That might be one way to do it. And venture capital trusts are the way you'd get exposure in the UK. The difficulty with all these things is that it's quite hard to get information. Whereas if you do want to invest in Tesla, they have to publish a quarterly report on their earnings, so there is transparency there. Whereas for venture capital and private equity, there isn't such transparency. So that's one of the difficulties. So you have to put a lot more faith in the manager, which is always questionable, having to put your faith into someone when there's not much transparency. So as long as there is transparency, you understand the risks, and you don't give too much of your core capital if you can't afford to lose the money. Yeah, I think that's an interesting thing to do. Okay, so David Garth says, Tesla's massively hyped up and minimal justification. As markets correct, value will win. Yeah, it's interesting. Somebody on Slack, as part of the community, said that they're convinced it's going to fall and that they're actually thinking of shorting Tesla at the moment. Oh, and here's the dog that did the injury. Hello, Ted. Rory says, what's your golf handicap? Considerable now, because I can't use a golf club, but I don't play golf. Chuck says, hitting the like button. Great. Thank you, Chuck. If only other people did that, because I can see that we've got 160 viewers and we've only got how many likes? How many likes have we got? No, we've got 237 concurrent viewers and 115 likes. So please do like the stream, and it helps us a lot if you do that. So we'd appreciate it. And somebody says the Fed buying the market. Yes, that certainly helped equity a lot. James Jerry says, hi Ramin, does gold also drop little further this quarter and then rise as gold price dropped 20 to 30%? Please, can you outline little on this? Yeah, I think gold is driven primarily by real interest rates and the strength of the dollar. And for members, there's a spreadsheet which we've got where you can work out the fair price of gold crudely using 3 variables, which you can get out of the Fred database. But essentially, if the dollar is weak, that's good for gold because it's priced in dollars. Weak dollar means strong gold. If interest rates are real interest rates and negative or go more negative, that's good for gold, because if you can earn lots of money with risk-free government bonds, then that is much more attractive than gold, which is a wasting asset that generates no income. So that's why those two models, those two factors work particularly well forecasting the price of gold. And if you put in the latest values from the Fred database into the model at the moment, it's not far off the exact value of gold at the moment. So gold isn't looking particularly expensive or cheap at the moment based on real interest rates or dollar strength at the moment. So would it move a huge amount in the next months, years? Really depends on those two factors. So if you have a view about real interest rates, will they go down? Will they go up? That will bear on the price of gold. Similarly on the strength of the dollar. And a lot of people say that, for example, there was an FT article today which was saying that if the vaccine is effective next year, that's going to weaken the dollar a lot, which would be great for gold. But the question is then what happens to rates and inflation, because that could counteract the positive effect. Okay.
Say thank you to Cyrimus, who's given you £1.
Oh, Cyrimus, thank you very much. Thank you very much for your super chat. That's very kind of you.
And the YouTube people
Or what YouTube people?
that support you on YouTube.
Yes. Brilliant. So Laura says, I should thank the people on YouTube that support us. So also we now have a YouTube community which you can do, which just supports us. You don't get any particular benefits other than making sure that we carry on making videos. And I am very grateful to you if you do that, seriously, because, you know, as I say, we're not supported by anyone other than you. So if you don't support us, then we won't eat. So please do support us as we depend on it. But also you may want to see more of this content. And I've got to say, it's not very kind of sensationalist content which we produce. We don't go for conspiracy theories. We try to base our videos on data. So you'll notice I talk about graphs a lot because we try to keep it as close to the facts as possible. Obviously, there is a step from facts to an outlook, but we try to keep it grounded in fact rather than conspiracies. So I think that's valuable for a lot of people as a kind of antidote to some of the stuff which we see on YouTube, which is frankly pretty amazingly bad, because it's not grounded in any fact. It is just stirring up fear and not factually based, and based on some very unlikely scenarios. So, for example, somebody has been saying that we're going to get fiat currencies completely redenominated into crypto in January, which is complete nonsense, and frankly really angers me when I hear it. So yeah, so if you do want to keep quality content on YouTube, please do consider supporting us, because we'd really appreciate it. Thank you.
Have you done the super chat?
Super chat? Is there a super chat?
World MSI versus
Oh
Dow
yes,
Jones.
right. And I can't see it.
I can just read it to you if you want.
Yeah.
Just says World MSCI versus Dow Jones Market Titans 100 Index question mark.
Market Titans. Okay. Yeah. So the Dow Jones Market Titans tends to be fairly concentrated. It's US concentrated, and MSCI World was at the comparison.
Oh, I've lost it again.
Okay, I think it was MSCI.
Yeah, it was
MSCI World. Well, as I said earlier, diversification's always a good idea most of the time. Okay. If you are going to be investing for the next 10 years and you don't have a particular insight into which region is going to perform best, which, let's face it, very few of us do, then that's why you'd buy something like MSCI World, because it takes a neutral position, which is that you just buy the big stuff, right? The big countries, big stocks, and you assume that success will beget more success, and that the large companies, the large countries will continue to perform well. But that's why I think MSCI World is probably better in the sense that it's diversified, whereas Dow Jones Titans Index would just go for the mega caps, and I think it's US based, in which case it's even more concentrated because the risk premium is just based on one country, and also one country which has performed very well over the previous decade, which usually means that it may not perform so well in the coming decade. So that's why I personally think that MSCI World would be better. Okay. Okay, so Randeep says, when do you think insolvencies will start arriving in big numbers, if at all? Well, they kind of have started coming already. There was an article in the FT which was talking about cumulative defaults in 2020, and we're already above where we were at this time in the year in 2009. So we're already having a lot of defaults, and you've just got to go. It's the same in the UK. It's the same in the US. Many companies that were weak going into this crisis, even with the fiscal stimulus, are still struggling, and many of them are going bankrupt. So I think until we do see an actual cure, which is going to be Q2 or Q3 next year, then we're going to have this period when a lot of companies may just not survive. So we're already there. And if you look at the credit availability, so the SLUICE survey, which I talked about in various videos, there's a very clear credit tightening, which usually after 2 or 3 quarters leads to an equity market sell-off. So that's certainly not supportive at the moment in terms of equity markets. But we're already seeing insolvencies pick up. So I guess we're already here. Will it get worse is the other question, I guess, which I think it probably will, because as companies, particularly the weaker companies, use up their capital, as they use up their profits from before the crisis. Obviously, once that gets depleted, there comes a point where their revenue, if it doesn't pick up, it's just a mathematical certainty that they'll have to become bankrupt, and then it may lead to insolvency. But in the US, obviously, Chapter 11 doesn't always lead to insolvency. Sometimes they restructure their debt and come out as a stronger company. But in Europe, it tends to be much more final. Jazz Rhodes says 100% predictable inflation rate, completely trustless, deflationary, easy to store, and easy to transfer. What other asset class has this attributes? Oh, I think you're talking about Bitcoin. Yeah. Well, the problem with Bitcoin obviously is its volatility. So it's certainly not riskless. That's certainly not true. But yeah, I mean, it's got a limited supply, which is a good thing in terms of, investing in something. If it's got a limited supply, then as long as the demand's there, it's great. But it is a Ponzi asset. It doesn't generate income, and it's only worth what people are willing to pay for it. So I think that's the fundamental problem. Another problem is that it's not backed by a government. Some people see that as a problem with fiat currencies, but in fact, I'd argue that, and Jim O'Shaughnessy says this in the interview, as you'll see, the US has a lot of guns and they're willing to use them. And a currency that's backed by that kind of government is a strong currency. So that's why I think, fiat currencies are going to be around for a long time, and certainly not going to be replaced by cryptocurrencies anytime soon. I mean, ultimately, a central bank can create its own cryptocurrencies. There's much talk of that at the moment, but I can't see normal currencies, fiat currencies, from being replaced by crypto anytime soon. And certainly, if governments see crypto as a threat, they will ban it. That's the problem. And if they lose control of their own currency and the ability to tax their citizens, what government is going to give up that ability? It's simply not going to happen. So while Bitcoin is tiny, it kind of flies under the radar, but at a certain point, it's going to become a threat to fiat currencies, and then suddenly it won't be seen with such a benign regard by many lawmakers. Okay, do you recommend GBP sterling inflation-linked bonds? I heard Schiller was recommending it as a hedge in one of his courses. Yeah, I mean, if you think inflation's going to be high, the thing with inflation-linked bonds is that if you have them, inflation has to be higher than the break-even rate over the period over which you hold the bond. Now, currently in the UK, inflation-linked break-evens are about 3%, whereas inflation is 0.7%. And that means that if you hold an inflation-linked bond or an inflation-linked bond fund, inflation has to average more than 3.3% over the next decade for it to be worth more than a normal government bond, 10-year government bond. So what you've got to think is, currently we're at 0.7%. On average, we're going to have to be at 3.3. So that means we're going to have to overshoot by about 2%. So inflation is going to have to be at 5%, at least some of the time, over the next decade, which means the central bank will have failed to do its job, which, let's face it, they haven't failed to do over the previous decade. So if you do want to hold inflation-linked bonds in the UK, just be aware that they have very long duration, huge volatility. The volatility is around, well, it's kind of equity-like. It'll be around 15%. And also the duration is something like over 20%, over 20 years. So that's why it's so volatile. So that's the problem with UK inflation-linked bonds. But they do hedge equity. So if you do think inflation is going to run away above 3.3%, then yeah, it's something to consider. Personally, I don't think it's going to get that high. At the moment, we're more worried about deflation than inflation due to the lack of demand. I hadn't heard that Robert Schiller was recommending sterling inflation-linked bonds. Interesting. Right, how are we doing? We've got another 4 minutes, just under 4 minutes. And please do like us. It's not too late. You can still like us, our stream. Just click on the thumbs up thing. Subscribe to our channel. Consider joining us, because then you can join our Fantasy Portfolio Challenge. And yeah, please do support us. And you can also join our YouTube community, as there's a button you'll see under the screen, under the video window, which now lets you support us directly on YouTube. I know some people don't like Patreon, so maybe this would be a preferable way
You get a lovely icon
of supporting us. And a beautifully designed icon. Yeah, it's beautiful. Which has a pension craft and a little crown. It is awesome. So it'd be great if you do support us. And Hisham Daoudi, I can see one of those gorgeous crowns right now. And I'm going to answer his question as a result. If you would be 40 years old and receive a large lump sum of cash, would you invest it 100% immediately in an index fund or dollar cost average until the end of 2021, after your stock market crash 2021 video? So firstly, let me say what I said in that video, which is what I'm assuming is that you're fully invested already and you're looking for a bargain. So if there is a crash in the equity market, it's a buying opportunity. Yeah. If you haven't invested yet, then I'd personally be cautious. So I would be drip feeding into this market. That way, if equity markets do crash, then you'll be able to buy at a cheaper price. But if you're already fully invested, then, you know, I think then why not consider buying more, or at least if you have some cash on hand, you can always buy more of the equity market when it does fall. The difficulty is if you are 100% equity allocated, then you can't do any kind of rebalancing from bonds to equity. But to answer your question, Hisham, yeah, I think I would be drip feeding in this kind of environment, because, you know, there's still this period, this bridging period between where we are now and when we get not just the rollout of the vaccine, but the vaccine kicking in and proving to be effective. Because it's one thing for trials to show it works, it's another for the government to get its act together and to get people all across the developed world inoculated. So there's going to be that period when we are still in a fairly fragile place. Plus, the US president still hasn't conceded, so that may not run smoothly. So that's my worry, really. Those are my worries. And the credit market's looking like it's flashing warning signals too. And the big daddy says, "Hi, your videos are interesting. Keep up the good work. I'm learning a lot from you. That's great. Thanks for that. Please do consider supporting us. And if you're a member of the community, you get to learn even more, you know, from me and the other members of the community. So I think that's why it's valuable." Okay. Let me scoot down a little bit. I'll see if I can see any more crowns before we end. And then I know somebody's a supporter. This is bullish. Says, "Please read further into Bitcoin. You're misinformed." I will. And if you can recommend anyone to come on the channel and talk about Bitcoin, I'd like that. I think that would be interesting. And finally, Kyle McBride says, "What 3 Vanguard index and ETFs do you think is a good idea for a new investor?" Well, 3 is probably overdoing it. You can just do it with 1, right? You just need 1 fund, which is a multi-asset fund. So you can go for target retirement. You know, you just choose a date on which you want to retire, and then it does everything for you. Or you can go for a life strategy. Again, you know, very simple. You just choose a level of equity you're happy with, 20% equity, 40, 60, 80, 100. And then it matches with your risk appetite. And then you're done. That's it. That's all you have to do. Just buy it, keep it until you retire. Oh, Talbot Sunbeamer. Sorry, I missed your question. So I'll just deal with that one and then we'll end. For the month of October, England had more deaths in 2012 and Wales had more in 2014, confirmed today by the ONS. Not sure we need to continue locking down and stifling the UK economy. I guess the point is looking at excess deaths. So how many extra deaths you get which are avoidable. And that's the key thing. Our behaviour can control those deaths, which you can't say about normal deaths. So I think, as long as we are willing to value human life over economic growth, it kind of makes me proud, I think. So personally, I'd be much more tilted towards having the lockdown or restricted movement. Maybe better test and trace system would be great. That certainly worked in Asia, and ensuring that we get good economic growth. I think that's important. Yeah. Okay, so let's end it there. Please do like us, do the thumbs up, subscribe to our channel, join us. We've got the Fantasy Portfolio Challenge, which you can only do if you're a member, where you get to win a year's membership fee for PensionCraft in cash, so you don't have to use it for PensionCraft. And thank you for your time. It's a great pleasure to speak to you, and see you in 2 weeks' time. Take care, everyone.